Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, a pivotal moment for the US economy. The Federal Reserve cuts interest rates for the first time since 2020. So how will that affect Americans and the rest of the world? The cost of 10 drugs under Medicare insurance in the US is lowered. Big Pharma says that price controls could hurt the development of medications. But will it? And China's retirement age is among the world's lowest, but that's about to change. So why is Beijing making its labor force work longer? It is seen as the clearest signal yet that central banks are winning the fight against inflation. The US Federal Reserve joined other banks around the world in lowering the cost of borrowing with a bigger than expected cut of 0.5 point. The policy shift by the Fed marks a turning point in the economy and for Americans who've suffered with a high cost of living over the past few years. The Fed's been trying to strike a balance between curbing price increases and not hurting the economy in the process. While prices have eased, the victory may not yet be complete. The next question the Fed must answer is how quickly it will cut rates again to avoid a recession, but without fueling inflation. Hamza Mohammed reports.
Searching for a rare soft landing for the US economy, the Federal Reserve lowered interest rates for the first time in more than 4 years. With the US labor market showing signs of weakness, the Federal Reserve hopes this move will unshackle the economy.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Before this rare cut, the Fed had raised interest rates 11 times since early 2022. Banks, borrowers, consumers, and companies suffered. The average interest rate on credit cards jumped to a near all-time high, rising from 16.34% in March 2022 to more than 20% today. The high rates had the desired effect, and the inflation rate eased from a peak of 9% to 2.5%. But the job market slowed, and the US economy now risks falling into a recession.
If the economy is not in a recession, the market tends to go up roughly 10 to 15%. And if we are in a recession, the market tends to go down about 10 to 15%. So it really is two different different and binary outcomes from a potential standpoint in terms of what the stock market may do in terms of the reaction.
Despite the cut in rates, the road ahead for policymakers and the US economy remains uncertain. Hamza Mohammed, Al Jazeera, for Counting the Cost.
Joining us now from Istanbul is Jamil Ahmad, who's chief analyst at online trading brokerage GTC. Good to have you with us again, Ahmad. It was a bigger cut than many of us had expected. What do you make of it?
Indeed, it was, Adrian. And in fact, it was a larger interest rate cut that analysts and economists expected alike, with the Fed moving by 0.5% overnight. And the interesting thing, actually, Adrian, was that the Fed, the US central bank, was supposed to get this party started, or the train journey towards lower interest rates in 2024. We were expecting for the time frame for an interest rate cut to occur as early as late and early 2024. That's how long we've been waiting for this date. But in fact, the ECB, the European Central Bank, the Bank of England, and other developed central bank peers have all started this party, but the Fed tried to start last night with a bang, and by starting it late. Why did the Fed move so late? Is because of stubbornness with inflation. I've always said, to use a metaphor for inflation, we need to look at it as a diet. Inflation was close to double digits in the US as early and as late as 2 years ago, and it was around 10%. So it needed to lose a lot of weight. And as sometimes you get when it comes to a diet, we moved towards 3%. We lost a lot of weight, but through January up until recently, that weight loss stored around the 3% level. It was only this month, indeed, that inflation started to move towards the middle 2%. That allowed the Fed to finally pull the trigger. But if we compare it to the likes of the European Union and the United Kingdom, inflation has trended back towards that 2% target sooner, which is why they were able to move first, but the Fed has moved last, but it has also moved by the bigger interest rate cut at 0.5% against the others who moved by 0.25%.
So how fine a line is the Fed treading now? What are the dangers of the US falling into recession?
That's a long way away, Adrian. Last year, the US economy was printing growth figures similar to emerging markets. At one point, it was close to 5%. Even this year, it seems to be around the 2 to 3% level. And we have to also take into account the US economy is structured somewhat differently. Consumer spending accounts for the largest component of US GDP, and consumers are still spending in the US. However, they say there's no smoke without fire. And recently, from August onwards, we have had a downturn in economic data, such as 2 weak non-farm payroll reports, which is the monthly employment reports. They come in much worse than expected. And some of the ISM data signals that global weakness is impacting the US. So we do have some concerns over US economic momentum falling, but a recession feels a long way away if it happens at all. Of course, we never say never. But overall, by the Fed moving larger than expected, it's also trying to provide the message that it's in control of the situation, and it is prepared to provide the medicine through lower interest rates that the US economy might need to withstand some potential pressures it's going to face between now and the end of 2024.
And do you expect the Fed to move again in the coming months before the end of the year?
Given into account that the Fed moved aggressively last night, and financial markets were expecting 100 basis points of moves this year, that means 1% of an interest rate cut. The Fed is halfway there. And now that they have moved more than we expected, we can expect for there to be one further interest rate cut over the course and the remainder of this year. It also comes down to the economic data. But the Fed has shown last night it's prepared to be aggressive. So now that inflation seems to be in control, we have to look out for the non-farm payroll reports, which are once again for our viewers, the monthly job reports that come out on the first Friday of every month. We have to look at the US consumer data and the PMI data. But I do expect the Fed to move one more time overall, and likely before the US presidential election fallout, which I think is going to make the global outlook and the Fed outlook much more unclear for 2025 onwards.
All right, so the US economy is the largest in the world. What does a rate cut in the United States mean for the rest of us?
Well, we have to consider that it was actually the US interest rates that moved first after the Russia and Ukraine crisis caused that inflation shock that we haven't seen in decades. So the Fed being able to move to such an extent, that provides some confidence that hopefully normality is resuming. Of course, since the mid-2000s, where we had the global financial crisis, all of us globally got used to lower interest rate policy. And in fact, many of us have not seen interest rates close to 5% in a generation or for many viewers in their lifetime. So now that the Fed is starting to move and US rates are starting to move, it does provide some confidence that matters might be getting back to normal. But I still think the newer normal will be a more moderate or higher interest rate policy. I don't think we're going to go back towards the 1%. We might need to settle somewhere around 3% interest rate policy, but hopefully that gives some confidence to award economic momentum that does need some support.
Jamil, it's always great to talk to you. Many thanks indeed for being with us again on Counting the Cost. Democrat presidential nominee Kamala Harris is hoping that lower drug costs could help her win over voters. Americans pay more for prescription drugs than anyone else in at least 33 high-income countries. In 2022, the annual cost of those medications was around $1,400 for each person. The Biden-Harris administration has reached an agreement with drug makers to lower prices on the 10 costliest drugs under Medicare health insurance. The deal is expected to save millions of enrollees around $1.5 billion in out-of-pocket costs in the first year. Well, the agreement, which will take effect in 2026, is part of sweeping changes under Biden's signature economic package, the Inflation Reduction Act. Had the new prices been in effect last year, Medicare would have saved $6 billion. The pharmaceutical industry has unsuccessfully tried to file lawsuits to stop the negotiations. Pfizer, among other companies, has warned that lower drug prices will affect innovation and hurt the development of cancer drugs and treatments for other diseases. Well, drug makers say that developing a new drug costs billions of dollars and involves a trial and error process in which many ideas fail to make it to market. But supporters of the Biden-Harris drug price reform point to the industry's sky-high profits. The global pharmaceutical industry generated almost $1.5 trillion in revenue in 2022. Last year, drug manufacturer Bristol Myers Squibb posted $45 billion in revenue. Merck reported around $60 billion in sales, and Johnson & Johnson raked in more than $85 billion. Joining us now from Milan in Italy is Andrew Farlow. He's the head of Global Public Health Initiatives for Oxford in Berlin and a senior fellow at Oxford Martin School. Good to have you with us, Andrew. Why do drugs cost so much in the United States?
Well, the US has a different system from many other parts of the world. I'm normally based in the UK, and we have an institute called NICE that regulates these things and puts things through a mechanism that works out what the effectiveness is. The US doesn't have that kind of centralized monopoly controller of pricing. So what you've just described is a kind of an innovation on that. You have to, in fact, go through a new regulation at the level of the government. You have to actually put through an act in order to do this. So this has meant, you just quoted a price that's like twice the cost of what it costs per patient in a country like France, for example. I'd argue also that the US is a really quite medicalized economy too. Its medical sector is about 4.5 trillion a year. The drug sector is a very big chunk of that, and this is about controlling that cost in the equation. Prices for new US drugs last year, new ones coming online, was 35% greater than the previous year, and they have a record number of blockbusters. The mechanisms to keep prices under control are not really there compared to other parts of the world. So this new Inflation Reduction Act, it was an opportunity to tackle this. My particular take on this is that this is a move in the right direction, but it's actually quite a small part of the equation. There are much bigger and more important things that could and should be done to control that growing level of prices. The reason it's become grasped to a degree by both political parties is that this has the potential, the way things are going over the next 5, 10, 20 years, to bankrupt the systems for providing healthcare in the US.
Big Pharma is warning that forcing them to lower drug prices or to sell them for less is going to disrupt innovation. Are they right, or are the big pharmaceuticals prioritizing profit over health?
No, they're not right. I can be quite blunt about that, I'm afraid. They have to say that. They're defending their position. I noticed that when this was announced, the share prices of the companies hardly budged. In fact, they probably went up around about this time. They reassured their shareholders this wasn't going to have that big an impact. Relatively speaking, this is quite a small measure. I know you noted in your introduction that had these prices been in effect a year or two ago, this would have saved $6 billion. Well, this is going to come into effect in 2026. The reason is that they have to allow the legal process to go through its course. So if you do that equation and you look at the rise in prices in recent years, the savings that are declared are not really just wiping out the increases in recent prices. I would argue that actually there's almost, I get into trouble for this, but there's almost too much easy money in the system for pharmaceutical companies at the moment in the US. The regulatory system is flagging things through that don't add a great deal of value to what's already there. And actually, if you look at that, therefore, they don't have much incentive to actually add value. So I would argue that actually that there needs to be a bit more reform to put the value on the drugs that actually generate higher expected impact on health. And you've illustrated the system is awash with money. Some of those big companies have so much cash they don't know what to do with it. So a root and branch approach, which really isn't very politically palatable by either of the political parties in the US, would move in the direction of a set of measures that was actually a bit tougher on companies in terms of what they produce. They wouldn't allow them to get drugs through the system on the basis of one study. They would require more minimally clinically important differences between what is being developed and what's currently on the market. There'd be more emphasis on randomized trials that are representative. I just picked off one example, but I could pick off a load more where the drug being used is not really matching in its use how it was trialed, and therefore the efficacy numbers are actually in the real world lower. So a few of these kind of things would actually improve the incentives of companies to produce useful drugs.
Okay. Andrew, really good to talk to you on Counting the Cost. Many thanks indeed for being with us.
Thanks very much.
And so to our highlight of the week. It's $900 billion a year. That's roughly how much it would cost the European Union to keep pace with competitors like China and the US. The findings were released by the former president of the European Central Bank, Mario Draghi, last week. The EU's share of the global economy is shrinking, and Draghi says that if Europe can't provide its people with security and prosperity, it will have lost its reason for being. His recommendations to transform the EU's economy include reducing energy prices, coordinating industrial policy, and raising defence investment. More than 300 million people who are currently aged 50 to 60 are set to leave the Chinese workforce over the next decade. That's the country's largest age group, and it's almost as large as the entire US population. The growing number of elderly people is straining the country's pension pot, and with a declining birth rate, fewer young people will replace those who've reached retirement age and keep paying into that pot. So to try to slow the decline in its labour force, China is to raise the retirement age for the first time since the 1950s. The change will take place over 15 years, starting in January. According to the plan approved by lawmakers, men will retire at 63 instead of 60. Women will retire at 55 instead of 50 for ordinary workers, and 58 instead of 55 for those in management positions. Starting in 2030, employees will also have to make more contributions to the social security system in order to receive pensions. Well, the announcement of the rise in the retirement age has led to mixed views among older Chinese workers as well as younger ones. Youth unemployment is high in China. Many people are worried that an expanded workforce would lead to tougher competition for jobs.
I'm worried that we modern people now are so competitive and distressed that our health may not see us through to that age.
I may feel a bit reluctant to work for such a long time, but I also understand this decision. The government may have to consider the issue of an aging population. I think from a macro perspective, I can understand it.
For sure this will impact me, but I think we should look at this positively. It's a good thing because our country has an ageing society. A multi-level pension security system's being built. So raising the retirement age is the country weighing up the pros and cons. It's a strategy that's beneficial to the entire country.
Joining us from Hong Kong is Alicia Garcia Herrero, Chief Economist for Asia Pacific at Natixis Bank. Good to have you with us again, Alicia. How significant is this? Other countries have already raised their retirement age. What's this going to do for the Chinese economy?
Well, it's going to help pay the pensions to start, because this is a big issue for China. The National Pension Fund has a big deficit. Numbers not fully, clear, but we know there is deficit. And I think the most important decision is really to increase the number of years that Chinese will need to work to receive a pension from 15 to 20. That's the big thing, because that's what gives a little bit of room, breathing space to actually pay the pensions. The retirement age increase is relevant, but it kicks off a little bit late because it starts in 2025 and it goes really slowly. But the contributions are very, very important, and that's just to make the system fundable, which hardly is today. They need to receive contributions from state-owned enterprises. It's just not sustainable. So it is important.
But as we said, youth unemployment in China at the moment is particularly high. What does this mean for the employment prospects of the younger generation? Good
question. It means that it will be harder. I quite agree with the comments which saw, by Chinese interviewed by Al Jazeera. It's going to be harder because by the way, harder, and China is going to be even less productive. China's productivity is decelerating. It's been the case for a decade. And the fact that older people will remain in their jobs as opposed to having, new graduates won't do much for productivity. But, it's kind of a must. Yeah, they need to finance these pensions. For young people, of course, there's another risk, which is robotization, AI. I mean, it all comes together on top of this delayed retirement age.
But with a dwindling workforce, to what extent is China, by raising the retirement age, simply kicking the problem further down the road?
Well, I mean, when you raise the retirement age, you basically get longer years of contribution. Of course, the minimum is 20, but if you start working when you are, say, 23 after college, and you go in, you may be there for 40 years. And that's the bet. The bet is that people will stay there for very long. And therefore, the amount of funds that will be incorporated, will be more. But your point is well taken, because there is plummeting fertility rate in China, especially since 2019, is really a very, very rapid reduction in the fertility rate. These actions might not be enough, because still the pyramid is getting thinner and thinner on the bottom, and that's not accounted for. So that in that regard, you're right.
And what is the current state of China's workforce? I mean, how many people within it are skilled or unskilled? And what is that impact having on China's economic growth?
It's a very good question, because, I want to make a point that is a little bit counterintuitive. While the labor force is actually falling in China, about a percentage point a year, the labor force is falling in the rural areas. Why? Because there's still urbanization going on. So people are moving into the cities. In fact, that depopulation overall, which is concentrated in the rural areas, is not explaining China's economic deceleration, because there are still people moving to higher productivity areas, the cities. So, and on top of that, to your question, there's also the labor force is being, of course, the share of skilled labor is higher and higher. So in principle, the worst will come when the cities can no longer accommodate people, because the urbanization rate will reach, the steady state, which is around 80, depending on the countries. Japan is a bit higher, US is a bit, but say 80. We're at 63 now. So by 2035, and this is important, all of this aging and depopulation will hit growth massively. We're talking about around 1.3 percentage points growth less every year for China once the urbanization process is over. That is when we will really see what depopulation means for China growth-wise.
Alicia, great to talk to you again on Counting the Cost. Many thanks indeed for being with us. Pensioners in Argentina are on the front line of President Javier Milei's attacks on the welfare state as the government pushes to implement its harsh austerity program. Last week, Milei presented his 2025 budget to Congress, which includes holding wages and pensions steady. He's previously struck down a law that would force the government to boost spending on retirement. Argentina right now has one of the lowest pensions in the region. Teresa Bow reports from Buenos Aires.
They say they're the first victims of President Javier Milei's cuts. Pensioners protesting in front of Congress against Milei's veto of a law that would increase their income by at least 8%. Norma and Jorge have been married for 43 years.
We have come here because we have rights, and the government is taking it away. They are taking our rights to eat. The president forgot about the poor.
Jorge used to work for a security company. His pension is a little over $200 a month. He says he spends 25% on buying just one medication. People here are angry. When Milei took office, he devaluated the currency to try to normalize the economy after years of exchange rate controls. But inflation rose to 25% in the first few months. Pensioners and workers are still trying to catch up with the increase in prices.
The government says a zero deficit plan is non-negotiable, and that's why the president vetoed the pensions law. But these people are saying that the government is hurting this country's most vulnerable, and that's why they plan to challenge Milei's austerity plan on the streets.
In the past 2 decades, each new government has changed the formula for adjusting pensions. Pensioners have lost out with every one of them. Maria Romero is 78 years old and comes to this nursing home to pick up food every day.
I have a daughter with disabilities. My son is able to work in construction sometimes, and we have my pension. I can't survive with what I'm paid, so I have to come here.
And it's not just pensioners who are struggling. The new administration has also lifted subsidies on fuel, electricity and transport. For millions, it's become a challenge to pay their bills. This soup kitchen feeds around 3,000 people a day. Pedro Salinas started to come here 2 months ago. He used to work in construction, but Milei's halt to public works around the country has left him without a job.
I was working in a company involved in public works, and when the government took office, me and 200 others were left without a job. So I had to start picking up cardboard on the street. With this government, we're all trying to survive now. Hopefully the situation will improve.
For now, the biggest spending cuts have been to Argentina's pension system. About 40% of the people in Argentina work in the informal labor market. Previous administrations have tried to get more people into the state system. This means there are now more people enrolled in a welfare program that's already struggling to afford to pay the minimum wage.
We do not have a pension system. We have a subsidy program, so when a person reaches 65, the government gives them something. But it's not related to the traditional pyramid. Today, of 7 million pensioners, 5 million of them are paid a little over $200 a month.
5 million pensioners are living below the poverty line in Argentina. Javier Milei is continuing to promise his reforms will benefit the country's economy. But increasing numbers of people have started to question his plans, and pensioners say they're coming at their expense. Teresa Bo, Al Jazeera, Counting the Cost, Buenos Aires.
And that's our show for this week. If you'd like to comment on anything that you've seen, I'm at A Finnegan on X. Try to remember to use the hashtag AJCTC, or you can drop us a line. Countingthecost@aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and entire episodes for you to catch up on. But that's it for this edition of Counting the Cost. I'm Adrian Finnegan from the team here in Doha. Thanks for being with us. The news on Al Jazeera is next.